All right, welcome to the Explainer. Today we're going to tackle a number that honestly has a huge amount of quiet power over your financial life. We're talking about your credit score.
So, what if I told you there's just one number that could basically unlock your entire financial future? I mean, think about it. A single number that lenders use to decide if you get that mortgage, or the loan for a new car, or even just a credit card. Well, that number is very real. And stick with me, because by the end of this, you are going to understand exactly how it works.
Okay, so what is a credit score really? Well, at its heart, it's just a three-digit number. It usually falls somewhere between 300 and 850. The best way to think about it, it's your financial report card. And just like in school, the higher the number, the better your grade, and, well, the more lenders are going to trust you with their money.
Right, so if it's a report card, how exactly is it graded? What's the rubric they're using? That's exactly what we're about to dive into, piece by piece. And here it is. This is the whole formula, right here on one chart. And the first thing you should notice is that not all these pieces are created equal. Not at all. Just look at this. Payment history and amounts owed, together that's a whopping 65% of your entire score. So let's start with the big one, the most important factor of them all. Okay, so factor number one, your payment history. This is, without a doubt, the most important grade on your report card. It's really the foundation of your entire financial reputation. 35%. Just let that sink in for a second. Over a third of your entire credit score boils down to one simple question. Do you pay your bills on time? It carries more weight than anything else. So you can see why it's absolutely crucial to get this part right. You know, a really good way to think about this is like your attendance grade back in school. It's all about consistency, right? Just showing up. Lenders want to see that you have a long, consistent track record of paying what you owe, when you owe it. Simple as that. So any black marks, late payments, accounts and collections, or really big stuff like a bankruptcy, those are going to take a serious toll on this part of your grade. All right, let's move on to the second biggest piece of the puzzle, amounts owed. And this is where it gets a little more nuanced. It's not just about if you're paying your bills, it's about how much of the credit you have available you're actually using. And this right here is the golden rule you'll hear from pretty much every expert. It's all about something called your credit utilization ratio. And the magic number? Keep it below 30%. See, if you're using too much of your available credit, it can look like you're stretched a little too thin, like you're financially stressed. And that can make lenders nervous, even if you're making all your payments on time. So what does that actually look like? Let's make it super simple. Imagine your total credit limit across all your cards is $10,000. To follow the 30% rule, you'd want to make sure your total balance, what you owe, stays below $3,000. It's that straightforward. And honestly, the lower you can keep that number, the better. Okay, so we've handled the two heavy hitters, the big chunks of your score. Now let's talk about the other three factors. They might be smaller slices of the pie, but they're the final pieces that complete the whole picture. So here they are, the final 35%. First up, you've got length of history, which is 15%. Pretty simple. Longer is better. Lenders love to see a long, stable history. Then there's your credit mix at 10%. This is all about variety. Having a mix, say a credit card, a car loan, a mortgage, shows you can responsibly handle different kinds of credit. And last, also at 10%, is new credit. This one's about being careful. Applying for a bunch of new credit all at once can look a little desperate, so you want to be strategic about it. Okay, so now you know the rules of the game. You know how the score is built. The power is officially in your hands. So let's make that shift from just knowing to actually doing. All right, here's your game plan. A simple 5-step process to improve your score. Now, the first two are the big ones we've already talked about, the fundamentals. Pay your bills on time and get that credit utilization down. But we're also going to cover a few powerful strategies that you might not have thought of, like why you absolutely should keep old accounts open, how becoming an authorized user can give you a boost, and why you need to check for errors on your report. Let's start with one that catches a lot of people by surprise. So here's the thing. This is a super common mistake. You have an old credit card you never use, and you think, I'll just close it, be responsible, right? Wrong. It can actually hurt your score. And here's why. 2 reasons. First, it makes your credit history look shorter. And second, and this is the big one, it wipes out that card's credit limit, which means your credit utilization ratio can suddenly shoot way up. So, the takeaway, unless there's a really good reason, keep those old accounts open. Okay, another huge tip, you need to be your own detective. Seriously, don't just assume your credit report is accurate. Mistakes happen all the time. The good news is you are legally entitled to a free copy of your report from all 3 big bureaus every single year. Just go to annualcreditreport.com, pull them, go through them with a fine-tooth comb. If you find something that's not right, a payment marked late that wasn't, or an account you don't even recognize, dispute it immediately. Honestly, getting an error fixed can be one of the quickest ways to see your score pop. So there you go. That's the blueprint. Your credit score isn't some big, scary mystery. It's just a system. It has rules, and now that you know the rules, you can play the game and make it work for you, not against you. So the only real question left is, what's the first move you're going to make?